Welcome to the WARR Hunt quarterly market update for the end of the 2026 financial year. I'm joined by Bianca Musico, Principal and Head of Advice at WARR Hunt, and also Dr. Steve Garth, Independent Investment Committee member. It's been a pretty volatile quarter, and we've seen a lot of conflict continue, interest rates, inflationary pressures and so on.
So with that background, Steve, tell us what's happened in the Australian markets for this quarter and the financial year.
Yeah, Bianca, you can see in the chart in front of us that over the quarter, not a bad return, 4% for Australia, but a little bit more modest when we look over the whole financial year. It's up 6.1%, not bad, not great. And you can see the Australian market's got a bit of a seesaw pattern. It really gets going and then something knocks it down, like a bad inflation print, gets going again, something else knocks it down, like the start of the conflict last March. All in all though, 6.1% return for Australian market over the financial year.
Not too bad.
So Steve, tell us a little bit more about international markets.
So that is a different story. When we look at the developed markets here, or the global markets, on the left-hand side, I've got the developed market index, and you can see it's up 12.5% for the quarter, which is a fantastic return. And it's up over 15% for the full financial year. So these are in Australian dollars. These are sensational returns. Now, the biggest part of the developed markets are the US, but also Europe and Japan make up big parts. And you can see that all of those markets are contributing to the return. They've all had great quarters and great financial year returns. And then on the far right, we've got the emerging markets. Would you believe it's up 35% over the financial year?
So tell us a bit more about the emerging markets. What are the countries, I guess, that stand out there?
Yeah, so the emerging markets are interesting. When you look at the chart here, you can see that the standouts are Korea and Taiwan. Now, I've got a little pie chart there that says the main players in the emerging markets are in fact China, Korea and Taiwan, and then India. China didn't do much, but look at the returns of Korea. Would you believe it's up 196% in Australian dollar terms over the financial year? And then Taiwan, well, they're a bit of a laggard. They've only up 100%. Over the full financial year. So this is because these are the companies that make the semiconductor chips. So again, the great driver behind the return of the developed markets were the big AI companies, that they need the semiconductor chips to make the AI work, which, by the way, has also benefited Australian miners because they dig out the rare earth materials used in semiconductors. So you can see it's really been an AI trade, but not what we hear about with Apple and Meta and Nvidia. It's now actually the miners and the semiconductor chip makers are really benefiting from the AI trade.
So Steve, inflation, interest rates, continuing discussion there. Tell us a little bit about how that's played out over the quarter.
You know, the best way to get a handle on inflation expectations and interest rate expectations is by looking at bond yields. Now, I know not everyone's cup of tea looking at bond yields, but bear with me. In this chart, I've got the Australian and the US 10-year government bond yields, which directly reflect on the price that you get from your bond portfolio. You can see in the last quarter, they shot up, those yields all shot up because of the conflict in Iran, and oil was up 80%, so inflation was huge. But what you can see since that in this quarter is the yield's been coming down in Australia, and that's in recognition that inflation prints have been actually softer than expected. That's good. So as inflation looks softer, the yields come down, bond prices go up. So we don't know what the RBA will do the next meeting, but there's every chance they'll leave rates on hold for a little while longer to see whether that pattern continues. The US, on the other hand, you can see that at the start of the quarter, interest or yields there continued to go up. That's bad. So they've got a big sticky inflation problem as well. Now, in the US, it's more likely that they will definitely have to raise rates at least once or twice before the end of the year. For bonds themselves, all in all, modest returns, but given a background of sensational equity returns, that's not a surprise. And keep in mind that bond yields are now 4 or 5%, so they really are there to protect the portfolios if the equity market does have a dive.
So Steve, reflecting on the quarter then and the things we've just talked about, how does that play out across the WARR Hunt portfolios?
Yeah, and you know, the WARR Hunt portfolios are so well positioned to capture what's been going on in markets. we're well diversified across both Australian and international shares and the emerging markets. So we're actually picking up all those fantastic returns that you've just seen. So all in all, the portfolios are well positioned for both what's happened and also what we expect going forward.
Great, thank you so much, Steve, for coming in and giving us that update on what has happened for the quarter. As we always say, if you have any further questions, please reach out to your WARR advisor. But thanks, Steve.
Thank you.
Thanks, Steve.